What's up, guys? It's Lucas from IntraAlpha. On today's video, we're going to be talking about the option basics that you need to know in order to be consistent and profitable in your option trading. If you don't understand these concepts, you really have no chance of any consistent results when you're putting on or taking off option trades. So if you're new to trading options, or more importantly, new to selling options, then this video is for you. We're going to break down all of the important aspects of the options price, what the Greeks are, and how it all works so that you have some sort of agency and predictability over where your options price is going to go in the future. Before we dive in, we really need to have a good understanding as to why options exist in the first place. Let's go back in time and pretend you're a big institution and you have a $100 million equity stock portfolio for some teachers union that you manage. You have earnings coming up, or maybe there's an FOMC meeting, or World War II breaks out, and you have to do something. You have to hedge your position. What are you going to do? Well, before options existed, you really didn't have any good choices. You could sell all your shares, but that doesn't work because you're going to have tax consequences, and you might believe in the company long term. You don't want to exit the position, but what else can you do? You could try to hedge that position with some uncorrelated asset like gold or something that works in the opposite direction of the stock that you care about. But even that is an imperfect solution because there is no perfectly uncorrelated asset, and you're always going to be spending more money, more buying power to buy that uncorrelated asset, and you might not even have that buying power. Now, this was and still is a massive problem for asset allocators and investors. They have huge positions and they need to hedge those positions in case of a market crash or some black swan event. So what are they going to do? They need to do what other people do in other asset classes, and they need to buy insurance. They need to use a leveraged product where they spend a little bit of money today to get a lot of protection over a period of time to protect that underlying asset. And that's what option contracts really are. The question is, how do you price that insurance? Luckily for us, two mathematicians, Black and Scholes, solved that problem for us, and they won the Nobel Prize as a result. These two guys found out the equation to fairly price options so that people could trade them and they could be a regulated asset on the financial markets. Over time, people started writing more and more option contracts, and this just continued to grow and grow until you arrive at the options market that you see today. Now, we can trade 0 DTE options on Bitcoin ETFs from our iPhone. Just think about how far we've come and how flexible and robust these option contracts really are for their ability to provide insurance on your financial assets. The importance of this history and this context is so that you understand that options contracts at their core are really just insurance products. So now that we have that understanding that options really behave and act a lot like insurance products, we can start to break apart how their pricing works and how you can understand that pricing when you go to make option trades or build more complex strategies. The important thing with options that separates them from every other financial asset is that they have a temporal component, meaning they expire one day. If your option is not in the money, that option contract is going to go to zero and be completely worthless upon expiration day. So what makes options unique and what makes their option pricing even more unique is how they take into account this temporal component, because over time, the value of the option has to decay to zero if that option stays out of the money. Now that you understand that aspect, you can see why Black and Scholes put together such a complex equation in order to price options over time as the underlying moves and as market conditions change. But before we go further, we need to understand a very core basic concept. Price, the options price, is determined by traders. It's determined by what the market is willing to bear. It's the highest price a buyer is willing to pay and the lowest price that a seller is willing to accept for that contract. You have to realize that price does not come from the Black-Scholes equation. Instead, the Greeks and the other attributes of option prices is derived from price. So price is the independent variable and the Greeks are the dependent variable. That means you have to know what the price is in order to derive the Greeks. It's true that that does work in reverse. If you were somehow provided accurate Greeks, you could back your way into what the price was and how much time was left on the contract. But it's important to realize that you can use the information presented in the Greeks to help you make informed decisions about what option contracts you might want to invest in or otherwise trade. Let's do a quick story and explore this in an analogous way. Let's say you're about to take a road trip and you're standing at that little counter because you're gonna rent a car, and they're about to ask you that special question: do you want to add the extra insurance to protect your car and yourself during the trip? So do you? The question is, what is the price of that insurance? Is it worth it? What are you getting and for how long? The only way to answer that question is to find out more information about your trip. How long is the trip going to be? How risky is the car that you're renting? How safe is it to drive? How much does that car cost? And sort of in the background, what are the current interest rates in the market? If you knew those variables, you could type them into your magic car insurance software calculator, and it could spit out the price that the car insurance company would like to charge for that insurance. The question is that price fair? As a buyer of the insurance, do you want to pay it? Is it accurately priced? Well, the insurance seller has the luxury of setting that price and making that determination for themselves. If you want to buy the insurance, you can pay the price or you can opt out. So let's take a look at this further. Let's say you buy the insurance and you pay $200 to protect the vehicle and yourself during the trip. And then the trip goes well and there's no issues. You bring the car back, there's nothing wrong with it, and there was no claim to make during the trip. So the insurance policy expires worthless. The insurance seller keeps the $200, the liability magically vanishes, and the two parties go their separate way. The insurance company has a max gain, and the insurance buyer, the driver, has a max loss. You spent $200 insuring your trip for no reason. So now, let's apply this exact same type of thinking to an options contract. Say you have 100 shares of Apple, and you are worried that Apple might crash, and the price is going to come down, and your asset is going to go down in value. Well, what are you going to do? You're going to buy insurance. You're going to buy a put contract. So now those same 4 questions apply. How long is this put contract for? When does it expire? How expensive is the underlying asset that it's protecting? What price is Apple trading for? How risky is Apple? How volatile is it? And how volatile does the market think it's going to be in the future? And in the backdrop, again, what are the prevailing interest rates in the market? If you had those variables, then you would know what the correct price of the option should be to protect those 100 shares of Apple. That is what the Black-Scholes equation does for us. That is how option pricing works. It's a magic formula that helps us determine what the fair and accurate price of insurance would be to protect 100 shares of the underlying asset. Now, as a trader or as an investor, price is the most important thing. You want to buy things for $1, sell them for $2. You want to sell things for $2 and buy them for $1. It really doesn't matter how you get there or any other input. If your entry and exit trades are profitable, you're going to make money. And for that reason, price is the most critical thing when analyzing option contracts or any investment for that matter. As we've learned previously in the video, what makes up the option price? It's actually the price set by people, by the market. It's the highest price that option buyers are willing to pay, and it's the lowest price that option sellers are willing to accept. Sometimes there's a gap between those two prices, and that is called the bid-ask spread. So when you look up an option price, it might be showing you what's called the mid price, or the halfway point between the bid and the ask. If you try to buy or sell an option at that mid price, is it going to fill? Maybe. Honestly, probably not. You're going to have to compromise a few cents in either direction beyond that mid price in order to entice the buyer or entice the seller to transact with you. You have to reach out and hit the bid or hit the ask in order to make something happen. Okay, now that we've seen from the market what the price is, we can use Black-Scholes to determine the Greeks. There's tons of videos on the Greeks and countless articles written on the web. So I'm going to try to give you an analogy for the Greeks that should help any new option trader understand how they work. Let's go back to that rental car universe and use it as an analogy for the options market and, more importantly, the option Greeks of a particular options contract. So the first Greek, delta, is really the price of speed. If you have a very fast car, it's expensive, it's risky, it's going to come at a higher price. If you have a slow car, it's safer, it's cheaper. The second Greek is gamma. That's analogous to the price of acceleration. If you have a fast car that accelerates very quickly, it's risky, and therefore it's expensive. Therefore, that is a more pricey option contract. If the car doesn't accelerate quickly, that's safer, and therefore it's cheaper. It's going to move less, it's less dangerous. The third Greek, theta, is the temporal component. It has to do with time. That is the price of each passing day that you rent that car. The price of duration is less per day on a longer term contract than it is per day on a shorter term contract. The fourth option Greek is vega, and this is the price of risk. Given that type of car, if it's a Ferrari or a Lamborghini, it is more risky than a minivan. And so if you are renting a high risk car, you're going to pay a premium. A higher volatility vehicle comes at a higher price. And that's the same way that it works in the options market. And this makes sense, right? You're going to pay a high price relative to if you rent a minivan to rent it for an entire month. You're going to get a bulk price and a cheaper price on a longer rental duration, safer, slower vehicle. That is how options work as well. That LA Lambo trip is about the same as a 2 DTE 50 Delta NVIDIA call option. It's super risky, it's very dangerous. Something great could happen, but it might end in disaster as well. Those high risk, high reward options and high reward, high risk vehicles are going to come at a much higher price to insure. Okay, so now that we've beaten to death that rental car analogy, let's look at what the Greeks really mean in terms of math and option lingo. The delta is how much your option price will change for every $1 change in the underlying. So if you have a 50 delta call option and your stock goes from $100 to $101, your option price will increase by 50 cents. And remember, in our analogy, delta is the speed of the vehicle. If you have a high delta option contract, it's going to move a lot more. It has a much higher top speed. A delta of 100 is going to behave exactly like 100 shares. A $1 increase in the underlying is going to move your option price by, you guessed it, $100, because the option contract represents 100 shares. So if you have a low delta, it's going to move at a low speed. And if you have a high delta, it's going to move at a high speed. The second option Greek is called gamma. And as we learned before, gamma is like the acceleration of speed. It is directly related to delta. Gamma is going to show you how much your delta value is going to change for every $1 increase in the price of the underlying. So in this way, gamma is exactly like acceleration. It's going to tell you how much faster your overall speed is going to go up if the price of the underlying moves by $1. That third option Greek is theta. That is the time component. In many ways, this operates like entropy or gravity in the universe. It is the underlying core principle of option pricing, in that the option's extrinsic value are going to decay to zero. How do you account for that? Well, if you're an option buyer, this theta value is how much your option price will decrease per day. It is the price you are paying for the luxury of having that insurance product in your portfolio. As an option seller, you are collecting this daily theta value each and every single day. As the option nears expiration, this theta value is going to increase as a percentage of the overall option contract's value, and it becomes more and more relevant over time and starts to move faster and faster as time runs out. The last option Greek is vega, which, by the way, isn't even a Greek letter, but that's beside the point. Vega represents how your option price is going to change for every 1% increase in the implied volatility of the option. Now, I know that's a lot of buzzwords, but this one's maybe the most important Greek there is when it comes to making or breaking your option trading strategies. Almost all option trading strategies are going to be dependent on what the state of volatility is and your opinion about Vega, volatility, and where it's going to go in the future. Everything else being held constant, option prices go up when volatility increases and option prices go down when volatility decreases. That just means when people are scared and the market is moving big in both directions, option prices are going to be priced higher than they would be otherwise because people are more interested in buying insurance during these uncertain times. And let's not forget rho. Rho is the Greek that is often left out, and it just simply represents the underlying interest rates in the market at that time. You can basically ignore rho. If you're a very advanced option trader, rho might come into play if you're holding option contracts that are very long in duration and the interest rate, the Fed funds risk-free interest rate, changes during your holding period. If the interest rates aren't meaningfully changing while you're holding options, rho will have no impact on how you trade or on your options price. Now, there is an underlying principle to Vega and option pricing in general, and that is called implied volatility. This is often the most misunderstood concept, but in many ways, it's the most important one to master. Implied means a forward-looking future outlook. Volatility means how much is it going to move? How risky is it? So implied volatility is how much the market is putting a premium on the future volatility of that underlying stock. When implied volatility is high, option prices are going to be high. Vega is going to be high. When implied volatility is low and everybody's feeling great and nothing risky is happening, then option prices are going to be low. Now, as an option seller, you basically want to be paying attention to implied volatility at all times. When implied volatility is high, you typically want to be an option seller because everybody is freaking out and they are bidding up the price of options. When implied volatility is low, you might not want to be a seller because maybe people are underpaying for this risk and something's going to surprise them and you will be left with a losing trade having sold that risk and taken it from somebody else. In these low IV environments, you might consider being an option buyer or getting leveraged on an existing position because the price of an upward or downward movement is just so cheap. So now, take a step back and ask yourself this question. Is buying short-term options before earnings and then selling them the next day a good idea in terms of the option Greeks? You want to be using these option Greeks to help you make a system and a strategy, a repeatable process that you can target certain deltas, optimize for theta, avoid gamma, and hedge your Vega risk when you have a portfolio of options. If you want to graduate from single leg long options to vertical spreads, credit spreads, debit spreads, iron condors, jade lizards, and everything in between, you have to understand these Greeks. Once it clicks, you never go back. It's not something you can unlearn or that you'll ever forget. As an option seller, you might use this information to consistently target a certain delta. You might like maintaining a daily theta value in your portfolio of $100, meaning your short option positions are paying you $100 each and every single day. So now, you should be asking yourself, do you want to be the person that buys insurance or the person that sells it? Do you want to be collecting those insurance premiums or do you want to be paying it? Do you want to be setting the price of insurance or do you want to be accepting of the price that the insurance company is setting for you? The answers to those questions should lead you to becoming an option seller. If you have any questions about the Greeks or how this impacts option selling, please leave your questions in the comment below. If you liked this video or you found it helpful, please subscribe to the channel to help other option sellers find it. Thank you so much for watching, and I will see you on the next video.